December 18th, 2025. A trader in Chicago tried to take delivery of 500 ounces of silver from his futures contract. Standard procedure: fill out the paperwork, pay the storage fees, arrange pickup. Except when he called the vault, they told him something that shouldn't be possible. We're temporarily unable to process delivery requests due to inventory reconciliation. Translation: we don't have your metal, but here's what makes this story terrifying. This wasn't some small regional exchange. This was the Chicago Mercantile Exchange, the largest derivatives marketplace in the world, the backbone of global commodity trading. And they just told a customer they can't deliver metal that's supposed to be sitting in their registered vaults. This isn't happening in isolation. Across the globe, precious metals exchanges are quietly implementing what industry insiders are calling delivery restrictions. Not suspensions, not halts. Restrictions. Carefully worded policies that make it nearly impossible to convert paper contracts into physical metal without triggering red flags, delays, and bureaucratic mazes designed to discourage actual delivery. October 8th, 2025. India placed an order for 1,000 tons of silver through the London market. Within hours, the entire London silver market froze. Lease rates exploded from 0.25% to 200% in a single trading session. Major Swiss refiner Metalor announced they wouldn't return to the market until January 2026. Think about that timeline. A company that processes precious metals in 17 countries walked away from the London silver market for 3 months because of one delivery request. November 28, 2025. Silver futures approached historic breakout levels above $54 per ounce. Gold surged past $4,186. Then the Chicago Mercantile Exchange experienced what they called a cooling system failure. 10 hours of trading halted across $26.3 million in daily contracts. The timing was extraordinary. Silver had gained 84% year over year and was poised for a breakout that would devastate short positions held by major financial institutions. The pattern is unmistakable. Every time physical delivery pressure builds, technical problems emerge. System failures occur. Inventory reconciliations begin. Market makers step back. The infrastructure that's supposed to facilitate delivery mysteriously develops problems precisely when delivery is most needed. But here's what should grab your attention about this moment. The London Bullion Market Association reported 844 million ounces of silver in their vaults. That's nearly 24,000 tons of metal supposedly available for delivery. Yet the market couldn't handle a 1,000-ton order without complete breakdown. The mathematics don't work. Either the silver isn't where they claim it is, or it's not available for delivery despite being counted in official inventory reports. This exposes the critical flaw that's been hiding in plain sight for decades. Most silver held in exchange vaults exists in multiple categories. Eligible silver sits in warehouses but isn't designated for delivery. Allocated silver belongs to specific owners like ETF funds and can't be touched. Registered silver is supposed to be available for immediate delivery to futures contract holders. The problem is these categories can shift without warning. Metal that appears available on Monday becomes unavailable on Tuesday through administrative reclassification. No transparency, no advance notice, just sudden scarcity when delivery demands appear. December 2025 has become the breaking point. Over 47.6 million ounces of silver were claimed for delivery in just 4 trading days at the Chicago Mercantile Exchange. That represents more than 60% of total registered inventory disappearing in less than a week. Historical data shows normal delivery rates running around 2 to 5% of open contracts. December saw delivery demands exceeding 60%. This isn't normal market activity. This is a bank run on physical metal. The response from exchanges has been swift and coordinated. New delivery procedures requiring 72-hour advance notice, enhanced documentation requirements, mandatory storage fee payments before delivery approval. Each hurdle designed to slow the process and discourage physical conversion. But the most insidious development is happening quietly behind closed doors. Sources within major bullion banks report internal memos discussing force majeure clauses. These legal provisions allow exchanges to suspend deliveries during extraordinary circumstances. The definition of extraordinary circumstances remains deliberately vague, giving exchanges broad discretion to halt deliveries whenever convenient. Meanwhile, industrial manufacturers are panicking. Solar panel production requires 247 million ounces of silver annually. Electric vehicle manufacturers need 25 to 50 grams per vehicle. Semiconductor fabrication depends on silver paste for conductivity. These companies can't accept cash settlements. They need actual metal. When exchanges can't deliver physical silver, production lines shut down. Supply chains collapse. The real economy suffers while paper markets continue trading fictional inventory. The industrial buyers are starting to bypass exchanges entirely. First Majestic Silver, one of North America's largest primary silver producers, announced in December they're selling directly to manufacturers at premiums above exchange prices. Pan American Silver followed within days. Why feed metal into a system that manipulates your product's value when desperate buyers will pay premiums for guaranteed supply? This creates a feedback loop that's accelerating the crisis. Less metal flows into exchange vaults. Inventory depletes faster. Delivery pressure intensifies. More producers withdraw from the exchange system. The mathematical reality is becoming undeniable. Global mine production peaked at 880 million ounces in 2015 and has remained flat while industrial demand exploded. Solar installations alone consumed 85 million ounces in 2020. By 2024, that number hit 247 million ounces. Electric vehicle production added another 40 million ounces of annual demand that didn't exist 5 years ago. 5G infrastructure, medical devices, defense applications, all consuming silver at unprecedented rates, while recycling recovers less than 20% from electronic waste. The deficit numbers tell the story. 149 million ounces consumed beyond production in 2024, fourth consecutive year of structural deficit. That shortage had to come from somewhere. Exchange inventories provided the buffer, but those stockpiles are now exhausted. Chicago Mercantile Exchange registered silver dropped from 290 million ounces in 2021 to 73 million ounces today. London Bullion Market Association inventories fell 40% since 2021. The buffer that allowed paper markets to function for decades is gone. What happens when the remaining inventory depletes completely? History provides the answer. March 1980, palladium markets, 2001 platinum crisis. When physical supply can't meet industrial demand, prices don't rise gradually. They dislocate violently. But silver presents a unique situation because it's simultaneously a monetary metal and an irreplaceable industrial input. When currency systems face stress, investors flee to precious metals. When technology advances, industrial demand surges. Both forces are converging simultaneously. Central banks understand this dynamic. China restricted precious metals exports. India imposed import duties, then removed them when domestic prices spiked. Russia accumulated silver reserves while limiting access for citizens. These aren't random policy decisions. These are strategic moves by governments preparing for currency instability while securing critical industrial materials. The kill switch isn't coming. It's already here. Exchanges have quietly transformed from delivery facilitators into delivery preventers. The vaults are empty, the inventory is fictional, and the industrial economy is about to discover what happens when paper promises can't become physical reality. This isn't market manipulation anymore. This is system failure in slow motion. The mathematics are simple, the timeline is accelerating, and the people holding actual metal in their possession are about to witness the largest wealth transfer in commodity history. The question isn't whether the paper market breaks. The question is whether you'll be holding promises or holding silver when it does.